to the Center of Entrepreneurship for having us today to be part of this series of lectures, and hopefully be able to assist you all with our experience as a startup ourselves, but also as what we see a key player in the Cyprus ecosystem in fundraising for your startup. So our company is Crowdbase, and today we're going to talk about startup financing and crowdfunding. A bit of what we're going to talk about, just a short intro about ourselves. We're going to explore some of the startup financing options we have here in Cyprus, what is lacking in Cyprus, and which would be the most viable option for yourselves at a certain point of your journey. And then we're going to go into crowdfunding, how it works, how it fits into the ecosystem. And further on, we're going to talk a bit about some bonus topics, more generally, how to fundraise, what to include in your pitch deck, what makes a startup attractive, and what turns down a lot of investors. Throughout the process, feel free to jump in, ask any questions you have. I would rather have this be a back and forth conversation rather than me and Panayiotis talking non-stop. And as I just spoiled myself, I'm Frixos. I'm the CEO and co-founder of Crowdbase. Me and Panayiotis both have a finance background, and we're running the day-to-day operations of Crowdbase. Panayiotis also studied in London, in LSE, and then we later met during our master's degree at the LBS, where we both did financial analysis. We have another co-founder, Daniel, who is the CTO of the company, which is something we're going to go further into down the line, but it's a critical part of every tech startup to have internal tech talent, and without him, this would not have been possible. So let's get started. We're going to go through some of the broad areas of financing, not just in Cyprus, but in general, starting with incubators and accelerators. What do they do? So incubators are usually the first step for every founder. You go there with usually just an idea, and they assist you through their experienced mentors, programs, connections, and network to structure your idea into a proper business. That might be through thinking about the business model, figuring out your customers, how you're going to do your marketing, outreach, and so on and so on. Accelerators are a bit more advanced for when you have a product, when you have a service ready to go, and you are ready to, as the name says, accelerate your growth, scale up, and expand. In Cyprus, we have a few of these. Aris by Deloitte in Limassol, so that might be a bit hard for you if you're based in Nicosia. We have Cyprus Seeds, which is specifically focused for academic research that is ready to become a business idea. So if you're doing, I don't know if we have any PhD or master students doing any research, but that would be more appealing for them. Idea by Bank of Cyprus is probably the most popular in, not just in Nicosia, but across Cyprus. They're sector agnostic, so usually they're open to any idea, and they offer, I think, about €10,000 grant at the end of the program, so they help you start up your company. And then there is a new one, Unity Growth. I think it's a paid program, but they're very experienced entrepreneurs in Larnaca. Then we have grants. This, again, they're mostly focused for research-based or development-based startups. So if you're working with a professor here at the university, assisting them in creating some kind of research, and they're ready to commercialize, usually they will go with one of those. There is also some grants for young entrepreneurs or pre-seed programs by DEC. What I would say on this, it's good to have them. It would be great to have them because they don't require any equity. They don't want to take any part of your business. But usually the application process is long, it's very bureaucratic, and sometimes it can do more harm than good from our own experience. But nevertheless, give it a go if you feel like you tick the criteria. Then we have angel investors. These are usually business professionals that have succeeded in their... Oh, sorry.
Can you elaborate on the risks with grants?
Yes. So I think the most relevant ones are the Young Entrepreneurship Grant by, I think it's the Deputy Ministry of Energy and Commerce, and the pre-seed and seed grants by Research, Innovation and Foundation. So unfortunately, a lot of these grants are structured by people that have never had, they never created their own business or even startup to begin with. So what happens, they are describing a process of funding something that would never work. In practice, for example, for the pre-seed program, they require you not to have incorporated your startup, wait until they've given you the go-ahead, then you need to follow a very strict flow and process for another year, year and a half, until you get to the point where they give you the money. And a lot of these programs also require you to show that you have the money in advance. So it's kind of counterintuitive. If you had the money, why would you look for a grant in the first place? Or if you want to move fast, if you're a startup and you want to be agile, why would you force yourself into this very rigid framework that restricts you from launching your product and getting started and exploring what's out there? So that's why I would say keep an eye out on a lot of those small text at the bottom of the application, because sometimes free money is not really free. Yeah. Moving on, yeah, angel investors, as I said before, usually successful business professionals, so people in the segment that they specialize, that have already had some kind of success, and they have money and they want to invest and they want to guide. These usually come early on in the life of a startup, and it's great if you have somebody who can act as a mentor plus a financier of your startup. And usually their guidance and their expertise and their knowledge is worth a lot more than the money they would put in. And this can really give you a good kickstart to your company and attract new investors later on. Because if they know, for example, Panayiotis there, he invested in this startup and he previously invested in Foodie as well, everybody will probably be looking at that and be like, okay, he knows what he's doing. It's a good indication for me to also get on board. The problem here is that in Cyprus, we don't really have an organized network of angel investors. It used to be Cyban, but they haven't really been, very active lately. But there still are a few that are actively looking for ideas. If you want, we can assist you in this. Usually they like to stick in their own segment. So for example, cybersecurity or tech in general, or tourism, for example. We might try to do something in this segment because through our platform, but this is something to come for the future. And then we have venture capital funds. This is your traditional institutional investor, which is essentially a fund. They raise a lot of money, 10, 50, 100 million, and then they go out there and try to make a lot of bets in finding the next big thing. What's important to note here is that they don't just want to be successful, these startups. In order for their unit economics to work and for them to make money and their investors to be happy, they kind of need to hit a home run, which is why they will try to bet on high risk, high reward ventures that are unlikely to be restricted geographically just to Cyprus. They will want something pan-European or even worldwide in order to have enough potential to make money for them. And this can come at any stage of the life cycle of a startup. We have a few of them listed here. The most active one is Genesis Ventures, which has been active for, I think, about 10 years now in Cyprus, but they have a very specific scope. They like to take startups from Cyprus and take them to the US. And that's a natural thing because they start with Cyprus, low cost base, good tax and all that, and then they go to the US, huge market, much more easy to scale up. There is the new VC fund, 33 East, that's been co-funded by the Cyprus government. It should start looking for investments in 2024, so keep an eye on that. And then there is several other venture capital funds from Greece mostly that are looking into Cyprus, like Unifund, which, as the name says, it was initially focused on ideas coming from universities. And then we have crowdfunding. What is crowdfunding? Is the process of a large number of small investors coming together to pool their money and invest or back an idea. Is anybody familiar with Kickstarter perhaps, which is the most common use of crowdfunding? Yeah, it's probably quite common by now. The different, what we're gonna see later on, there are a lot of different types of crowdfunding, and we're not doing exactly what Kickstarter is doing, but crowdfunding can be a great way to finance your company, depending on what you are doing and when you are doing it, because other than the funding, it can also give you a lot of marketing exposure. A lot of these campaigns have gone viral, like Oculus Rift from Kickstarter that was later bought by Facebook. You get crowdsourcing of ideas, so a lot of people, if you have a room of 500 people investing in your idea or startup, they can give you their own perspective that is usually very valuable. And you can also validate your concept. If, for example, none of these 3-4 guys before wanted to invest in you because they didn't believe that there was a market for this thing, people didn't want this, and you can go out there and do a crowdfunding campaign and showcase to them, like, okay, I have 100, 200 people that want to invest in this because they want to see this product, then naturally you're proving that there is demand for your product or service. And yeah, as I said before, what is crowdfunding is basically raising money from a lot of investors, but small amount of money, and in turn you give them something that depends on the type of crowdfunding. So there's usually 4 large areas of crowdfunding: equity, debt, rewards, and donation. For ourselves, Crowdbase, we focus on equity and debt, which is the first 2, and what we call investment-based crowdfunding, because it's not just backing or donating to a campaign, you are essentially investing in these companies. And we'll see a bit more. What are the benefits? Actually, I'll talk a little bit more. So equity is essentially you get a share of the company. Debt, you lend money to a company. Rewards, you get like a product, early stage product, usually like a demo or an MVP of the service. This works quite well with board games. I think we have a very successful Cypriot startup which did this, and they raised 700,000 from Kickstarter, so it's very impressive. And then we have donation, which would be your traditional charity. What are the benefits for ventures? You get a lot of marketing exposure. This we already seen from what we did in the past already. You get the concept validation if you don't have that already from the market. And then you build your community, because if you manage to get people that are using your product to also invest in your startup, then these people are going to want you to succeed no matter what. They're going to go out, talk with their friends, tell them, okay, you know, I invested in this thing, let's go use it. So they become essentially advocates of your service or product, which is an amazing value for you. And why do investors want crowdfunding? Is the accessibility. Traditionally, to invest in startups, you would need something in the range of 100,000, but through crowdfunding you can invest from 100 euros. There is diversification of portfolio. I won't go into much the boring finance stuff, but essentially you're spreading your risk. And then there is the desire to back new and innovative ideas, because if you see something and you want it to come to fruition, for example, let's go back to the example of Oculus Rift, the VR headset. A lot of people just wanted to see it happen and wanted to see it, to use it in the future. So that's why they backed it. And I'll give it over to Panayiotis now to discuss a little bit more specifically how we select the projects that go on our platform and how we work to bring them hopefully to fruition and have a successful crowdfunding campaign and raise the money that they're looking for.
Thank you, Frixos. Hi from me, everyone. This might not be so relevant for you right now if you are not in the stage where you are actually have a company, a startup with an MVP, a minimum viable product, and you're ready to launch a crowdfunding campaign, this might not be as relevant for you, but it's good to have in mind how we work at Crowdbase and what's the process that the companies take in order to raise money through our platform. So before the launch, we usually start with initial discussions with companies, like a phone call or an email, and then after that maybe a couple of meetings to ask a few of the details about the company, an overview of the company. We will see the pitch deck of the company, we'll see maybe some financial projections, maybe their business plan, and ask questions and understand more about what they are doing, and essentially assess whether this company is a good fit for a crowdfunding campaign, because not all companies are great for crowdfunding campaigns. Usually you would like to see B2C companies raising money with crowdfunding, business to consumer, because these types of businesses have business models that investors, retail investors, can understand, because as they are directed to a consumer knows and understands how to use this product or this service. So the business model is much easier for a retail investor to understand when compared to a B2B, business-to-business company, which the business models can become quite complex and very difficult for a retail investor to understand. So we assess whether there is a good fit for a crowdfunding campaign through this initial screening, and after that we continue with some deeper analysis. We go deeper into the financial projections and the business plan and the nitty-gritty details of how this will play out.
And we're going to see a little bit later what are these areas that a lot of investors are looking for, that usually are more or less the same. So it's beneficial to you to know these in order to understand what to showcase to them and which questions you should be prepared to answer when you meet with potential investors.
And usually at this stage we will also negotiate on the valuation of the company. We will decide the minimum and the maximum amount that we will raise through the campaign, then the percentage of the company will give out, and all those details we'll get them down and negotiate and confirm with the company. After that, we'll proceed with a KYC, know your customer, and due diligence, which is essentially a process we take to confirm that all the information that will be presented to investors is actually correct, fair, and not misleading. This is a regulatory requirement. I don't know if Frixos has already mentioned, but Crowdbase, since we are in the investment-based crowdfunding arena, this is a regulated activity. So as Crowdbase, we are regulated by SciSec. So this is a regulatory requirement as well, that all of this information that we will present to investors is actually true, fair, and not misleading. And after that, the campaign goes over to our investment committee. Our investment committee sees all of the details over there and decides whether to proceed or not with the launch of the crowdfunding campaign on the platform for investors to start investing in this company. After that, there's a campaign launch, and usually campaigns run for between 2 and 3 months. And at this time that the campaign launches, we start implementing our marketing strategy. As Frixos mentioned, a crowdfunding campaign is a great opportunity for your startup to gain marketing exposure. So this is a very critical part of any crowdfunding campaign, how you present the story and the narrative out there to get investors excited about your startup and make them invest in your startup, and also target current or potential users of your startup to turn them into investors so that they can become brand advocates, what was Frixos was talking about before. Okay, so this is a marketing campaign. During these 2 or 3 months, the funds are collected through the platform, and at the end of the campaign, if it's successful, then the startup or the company issues these securities to the investors. It can be shares, it can be convertible loans, it can be bonds, it can be anything, any financial security. And at the same time, we release the funds to the company to start doing what they said that they would do. Okay, so as Crowdbase, this is our journey so far. So Crowdbase was co-founded in October 2020, so a little bit more than 3 years ago by Frixos and Daniel. I joined a few months later, about 8 to 9 months later, whilst we were waiting for our regulatory license by SciSec to be approved. This happened in January 22, and then we launched our first campaign. Our first startup campaign was Easy Boat. It was launched in October 22 and ended in December 22, having raised 470,000 euros from 141 investors. This, so you can get a sense of the scale that we are working with at the moment in terms of money raised, and also the numbers of investors that we managed to attract up to this point. So this was the first campaign, EasyBoat. The second campaign launched in February 23. This was Snap. This is a beauty and wellness appointment booking application. You would be able to use this hopefully within the next month. They are currently at their beta launch. This is an application on the phone, essentially, which you will use to book appointments, to get a haircut, to do your nails, to do whatever. So in general, beauty and wellness appointments, you will be able to book them through this platform. So this was a startup. This was a couple of guys that had this idea, developed this product, had the marketing background as well, approached us. We discussed the details and launched this campaign. 210,000 from 44 investors. So these are both startups, but as Crowdbase, we don't focus 100% on the startups. We also focus on real estate projects as well. So the Courtyard was our first real estate project, which raised 574,000 from 75 investors. This is a big residential gated project in Nicosia, about 6 apartment buildings of 66 apartments. The total cost of this project is projected to be around 24 to 25 million euros. These guys raised a lot of funding themselves, like 4 to 5 million from their private investors. They raised money from the bank through a loan. They got credit line from the bank. They got credit line from the contractor in order to do this. They will get funding from the sales of the apartments to complete. And we've also allocated a small percentage of the total cost, this percentage, 574,000, to be raised through crowdfunding. So this was a chance for investors to participate in real estate investing with very small amounts, from 500 euros only. When in the past you couldn't access real estate investments from such small amounts. And these investors got into this investment at the same terms as the huge investors that invested a lot of money. So we believe this is a great opportunity for Cyprus as well, especially for Cypriot investors. Cypriot investors in general are not that familiar with what investing in a startup means, but they are much more familiar with what investing in real estate is. Everybody knows what it means to own an apartment and rent it and get rent, and everybody understands that. But with a company, it's much more difficult to understand and explain to investors. That's why we felt the need to get also into the real estate market.
Sorry.
Yes.
You mentioned earlier that investing through a crowdfunding platform could lead to like something along the lines of stock or shares or something in a company. But how would investing in a real estate work? Like you get percentage of the rent or something?
So, thank you, great question. So for real estate, you can structure it in a lot of different ways. I can talk about this specific way, this specific project that we did. So this specific project, there's a company was set up to manage this project, build it, and the strategy of these people that wanted to do this project is to build and sell the apartments. So not build and rent and give like rental payments to investors later. So it's built to sell. So the company is owning this land and the buildings that will take approximately 25 million to build, and then with 2.5 years to complete the construction and sell all apartments, and the revenues from the apartments will be around 33, 34 million euros, something like that. So you get the revenues, you get the costs, and the profits are going to be distributed back to investors, and that's it. This is the nature of this project.
So you essentially get shares in the company which owns the project, and then at the end of the project they will kind of buy back the shares at a higher price, so you get your the amount you invested in plus your profits.
It's guaranteed that the selling price will be more than what you invested.
There is nothing guaranteed when you're dealing with equity. So because you're an equity owner, you have this stake in the company, you can get more or you can get less. So we expect the investment to return around 70% in 3 years, but that's expected. You can go higher or lower, or you can even lose all your money. With real estate, it's quite unlikely for that to happen because you have the fundamental value of the land and the other money that was invested in the project. But with startups, it's a real possibility.
Yeah, and let me just jump in here, just because guaranteed is a very strong word. When you talk about investments in general, by definition, nothing is guaranteed. Your capital is always at risk when you invest money. It can be in anything. Nothing is guaranteed. I want to be perfectly clear about this. Nothing is guaranteed. And if anybody is coming to you and offering you an investment with guaranteed returns, think twice and ask more questions and understand better what they are selling you. So let's go to the customer journey from an investor point of view. If you wanted to invest in a company, in a startup, in real estate through Crowdbase, how would this work? It's about a 10-minute registration process on the platform. You give us some basic information, you answer an investor questionnaire, so we are able to assess your economic profile and be able to provide you with the necessary risk warnings before investing, so we know that you understand the risks that you are taking, and also an ID verification process, so it's a picture of your ID front and back and a selfie to verify that you are the actual account owner. And this information is also going to be used because these shares, these financial securities are going to be issued in your name, so that we need to have this information, and it's also a regulatory requirement, as I talked about before with CySec. Once you complete this process, which takes approximately 10 minutes, we usually review this information within minutes and verify your profile if everything is okay, and ask for more information if, for example, your proof of address might be more than 6 months old. So I'm telling you, you need to provide a proof of address that's less than 6 months old, whatever. So if everything is okay, account is approved, and then you can start investing in any project you would like. Okay, so let's talk about some of the common things that make a startup fundable, some of the things that investors are looking for. So let me ask again, I know the guys asked before, but is anybody here thinking about starting a business anytime soon, let's say within the next year? Okay, couple of people. How about thinking of starting a company within the next 5 years? Okay, so this might not be as relevant for you then, but it's good to have in mind, I think. I mean, yeah, this is an entrepreneurship lecture, so I assume you have some, you would like to start a company, or thinking about starting a company, or want to know more about what it means to start a company. But in any case, these are the things that investors pay the most attention to when identifying an investment opportunity. So for us and for many other investors that we talk to, the most important thing in a startup or in investing in a company is the team behind it. So does this team have the relevant skills or the relevant experiences and knowledge and expertise to deliver what they promise that they will deliver? So let's say, for example, we wanted to start Crowdbase, and it was me and Frixos, and wanted to start a fintech company, a financial technology company. If both of our backgrounds were in geology, for example, and we want to go and raise money for this, the investors would ask, okay, so how come you started a financial technology company? Your background is in geology. So it needs to make sense, you know. You need to have the relevant experiences for the kind of startup that you are going to do. Then, the commitment, a huge thing that comes up in Cyprus a lot, because you have a lot of people, a lot of entrepreneurs that want to start companies and have full-time jobs, 9-to-5 jobs, and they like to start working on the startup on the side, as a side hustle. That's okay. There's no problem with that. However, if you wanted to go and raise money from investors in your startup, then you need to show commitment. You can't be having a full-time job working on a startup as a side hustle a couple of hours a day and then go and get money from investors. So you need to be able to show commitment. And then finally, skin in the game. This talks about your percentage holding in the company. When investors invest in you, they want to feel secure that your interests are aligned. So therefore, as an investor, I want the entrepreneur to have a big percentage of the company, so they are motivated to take the company forward. If they have a very low percentage, then they might not be motivated enough to take the company forward. So this does not bite well for the investor.
Before we continue, a small comment on the team part. What usually happens is that you, or like a friend of you or a team, has an idea, and they want to create a startup, let's just say, whatever that startup is. And you find this idea and you get very excited and you go ahead and start building it, and then you try to create a team around that startup to fit the needs of it. That might be tech, might be whatever, economics, technical, engineering, design, and all that. It's much better usually to find the team first, find the people, could be in this class or friends or whoever else might be, find the team that is willing to work on something new together with you and it has the same commitment as you do, and then look inwards, look at the skills you have together as a team and figure out what you can build based on that. This is just one of the common pitfalls that usually happens with early stage startups.
Continuing on, is the unique selling proposition, which is essentially what differentiates your product or service from the other products or services out there. So what's unique about what you are pitching me? Why would someone would like to use this solution over the other plethora of solutions that are out there and available to use? You need to be able to answer this question very clearly to investors if you would like to get their money. Another thing is a practical solution. So is it actually addressing a problem? This thing that you are pitching me, is it actually solving a problem? Is it actually needed in the market, or is it just like a fancy thing that just looks amazing? Then the traction. Traction is seen as very favorably by investors. If you are able to demonstrate to investors that you've gained some traction, this is seen very favorably. Traction can be in the form of sales, already made sales, or pre-orders for your product. You go to an investor, you say, I have 50 people waiting for my product. Here they are, here are the orders, stuff like that. This helps a lot. Any other awards you might have won, like in the university or outside of the university, maybe in this country or other countries, any awards that you win can be seen favorably by investors. And lastly, any media coverage, any publicity you generate with your efforts is again seen very favorably by investors.
Good publicity, right? No burning down anything or out of testing.
Okay, and another thing is the scalability. So if you wanted to attract big investors, they would like to know that this opportunity, this startup, has the potential to become huge, to provide 10x my money, 20x, 50x, 100x, whatever. So this is achieved if your startup is scalable. And what does scalable mean? Is having the right technologies to be able to support the scale up of the company. For example, you might build an app that can comfortably support 1,000 users at the same time. But what happens if 500,000 users go on the app? Can it support that? Is the tech stack built in such a way so that we can accommodate bigger and bigger and bigger and bigger numbers at the end? After that is the unit economics. So they do need to make sense, and they need to improve with scale, like the economies of scale that you're talking in your economics lectures and stuff like that. The unit economics need to make sense. If per user I'm losing money, then I'm never going to scale.
For example, if it costs you 50 euros to gain a user, but you're only making 10 euros out of that user, it looks pretty bad. But usually that's the case at the start of every company. And then you can push down the cost of acquisition and hopefully push up the revenue you generate per user. That's usually a start. But you need to be able to make that in the long term. If you continue to be, losing money on every new user, what's the point of scaling up? You're just gonna go bankrupt faster.
Yeah. And the buzzwords, if you want to write them down and check them later about what Frixos is saying right now, is the customer acquisition cost, the CAC, as a word that a lot of people use, is what it costs you to acquire a new customer, and the lifetime value of a customer, which is actually what amount of money you expect to earn from every single customer through their lifetime. And then automation, 2024, ChatGPT, AI, stuff like that. We've progressed a lot with technology, so you have to make sure that all the mundane and manual processes that can be automated should be automated, so that you are more efficient and you don't waste time and resources and salaries and stuff like that for things that a computer can do. So you need to automate as many things as you can in the company. I think finally, another thing that investors look favorably is the market. You need to be able to define your market, and you need to be playing in a big market. If your eventual target is, for example, Cyprus is usually it's a small market. So if you want to raise thousands and thousands of money and become like a millionaire or a billionaire, most probably you're not going to do it by focusing just on the Cypriot market. So you would need to have bigger ambitions than this, maybe pan-European or global ambitions. So you need to be playing in a market that is big enough to generate a lot of returns. And this goes hand in hand with the expansion as well. I want to talk about some of the common pitfalls that startups do. You can take it.
Yeah, this is a bit from our experience. Since we started about 2 years ago, we've seen, I don't know how many more, about 200 ideas, even more, 300 ideas so far. And there is usually the same mistakes are repeated again and again. So hopefully we can help you avoid them. Equity dilution. So this is, I think, something that Panayiotis mentioned before. As a founder or a founding team, you need to make sure that you hold on to as much percentage of your company for as long as possible. If you start a company and you immediately give away 70% to an investor, an angel investor, or whoever else, in return for services, and you are left with only 30%, then it's quite clear that you wouldn't have the motivation to run this startup for another 5, 10 years, 15, 20 years. So it's quite important to keep on your equity. This is your biggest, let's just say, gunpowder to use or resource to use to grow up your startup over time. And usually the reason the first one happens is because of the second one. So it's because a lot of people don't structure their funding round. And what do I mean by this? Usually what startups come up to us and say is like, okay, I have this idea, I'm gonna create the next foodie of Cyprus. And I just need 10 million right now, and I can do it. I can turn this business from loss making into a profitable, successful business in 3 years.
Check on visa.
Sorry?
Check on visa.
And this is the biggest mistake, because if you're asking for 10 million and you want to keep 70% of the company, all of a sudden you're asking somebody to invest in something that's worth supposedly 30, 40 million euros. And this is not the right way to do it. The right way to do it is breaking down into rounds over time and into milestones. And as you hit those milestones and you develop new features and you expand into new markets, then you raise more and more money. This is usually what we call pre-seed round, seed round, Series A, B, C, D, and then you get to a point, hopefully, you sell or you get listed in the market. Just some practical numbers for pre-seed round. Usually 100 to 300,000 is more than enough, then 300 to 500,000, and then you can go 1, 2, 3, 5, 10 million. But if you are looking at a business plan or a budget and you need more than, I would say, 250,000, probably you're accounting something wrong. Overvaluation, yeah, this is the same, okay.
Can you explain the previous point a bit? Because from what I understood, we should not be looking for what the potential of the product is, but rather evaluating at the specific stage of how much we could look for some funds.
It's a combination of both. So if you do the correct exercise of creating a financial model which captures the potential of your idea and company in the long term, and then you structure your rounds appropriately, you'll be able to capture both the potential, but also ask for the right amount of money at the right time, at the right price. So, for example, let's take a more practical example. We start foodie today. I have just the idea, me and Panayiotis, and we start developing. Okay, it's not just the idea, at least we have the MVP, and we go to investors and we ask them for, let's just say, 200,000 euros. And we say our company is worth 1 million. This essentially means we're going to give out 15%, 16 point something percent of the company.
Yep.
We take this money, we go build, we get some customers, and we run out of money again. We want more money to have more marketing, expand to another city, and so on. We could go back to the investors and be like, okay, this time we have all this track record now, we built so much, we own 500,000. But now our startup, we can claim it's worth 5 million. So we give out another 10%. We go back, use that money, we build, we expand whole Cyprus, and we reach a point for the next round. Again, we are closing on to profitability about now. We raised the last round, maybe, let's just say 2-3 million, the 10 million valuation, we give out the last 20%, and then hopefully by that time, or another 1 or 2 rounds by that, we are able to reach profitability and start returning money. So in this way, if you do it structurally and in steps, you end up in aggregate, in total, you raise a lot more money and you give away a lot less of your company rather than going from step 1 and asking for the entire 5 million from the first step, which probably nobody will give you.
Is that clear?
Okay. So yeah, for evaluation is what I said before, like if you ask for all the money up front to get your business from idea into profitability, you're going to ask for too much money and you're going to value your company a lot higher than what it actually is worth. And the trick here is that you might be able to do this with friends and family. You go and tell them, okay, give me this money because you know me, we're friends or we're family, I'm going to build this thing. And you give away, let's just say 10% at whatever valuation. But then once you go to more sophisticated investors and they start challenge you on the valuation, you might be forced to do what we call a down round. So raise less money at a smaller valuation, and that looks really bad because you didn't structure well your first round. And usually what you want to do is you want to reward these people more that invested in you first, who believed in you first. So it's kind of both financial sense, but also a bit of business, professional relationships to keep them satisfied. This is one of the biggest mistakes we often see. A lot of people are slow to launch their idea. And with the tools that we have nowadays, you can build a website in a few hours, so you can get an MVP going again in a few days, maybe weeks. You should strive to launch an idea or an MVP or a beta version of your products as soon as possible, and start collecting feedback from customers or potential users in order then to iterate your product through the feedback you get from the market. If you're waiting to launch something perfect and something that will amaze everybody and all your friends once you launch it, and there is no bugs, there is nothing wrong with it, it's amazing, it's ready to go, then that will most likely never happen, or it's going to happen way too late. You will have already burned through a lot of money and a lot of time that you could have used to get ahead of the competition and improve your product.
That's actually impossible because you can't possibly know what the market really wants. You have an idea, you have an approximation, what you have in your mind. Okay, so the market needs this product, but if you don't launch and see it actually working in the market and get feedback from the market, you can't improve on your product. So this is an extremely important point.
Yeah. And then just a quick overview of what a pitch deck should include. So a pitch deck is essentially a 10-15 page presentation that you send to an investor as the first point of contact and first description of your idea and what you want to do and how you want to do it. So very important, describe the problem. Panayiotis mentioned before that your idea should be solving a practical problem and not just be something cool that you can do. Then it would be the solution. How do you solve this problem with your tool or service?
You say it has to solve a practical problem and everything. Many businesses are using niches, like foodie is a comfort thing. It's not like a necessity to have foodie. You can still call the restaurant and order from them, but it's not a problem.
For a lot of users, I see what you mean.
The problem is for me to get up and go to foodie and
no, you get the
go
phone.
Go to the restaurant and do it. Yeah.
Oh, you mean you can do it by calling?
I can call the restaurant.
Yeah.
It's the convenience, as you said before.
It shouldn't be. It's not really a problem, though, is it? Like, it's just a matter of convenience.
Convenience can also be. Yeah,
inconvenience can be a problem.
Can be a problem.
Yeah.
Doesn't need to be life or death situation.
Yeah. Don't take the word problem too literal.
Yeah. It might be just I'm bored to call because actually this is something that happens a lot with the new generations. Millennials, Gen Z, they don't want to talk on the phone and they would much rather use an application.
And also the problem with calling is also you can't make sure that the order is actually correct. So no, I told you I didn't want salad in my. No, you didn't tell me that. Okay. But if you do it online, then everything is there. So you also reduce the probability of a human error as well. So there's kind of actually a lot of things that this solves. Yeah.
In case of foodie, we can say that also maybe delivery is not a problem for the customer, but for a business, maybe they struggle to deliver the food. So
that's a problem you solve for the business. Yeah, because food is a marketplace.
B2B2C.
Yeah. So it sits between the restaurants and the end consumer. So it actually solves problems for both of them. So this is what usually marketplaces do, mediators. Like ourselves, which we sit between investors and startups as well, looking for funding.
Afterwards, the business model. So how do you make money out of this thing that you built up? A lot of people have built cool services or products, but if you can't monetize it over the long term, then that can be quite long because, for example, Facebook didn't start, making money for 10, 15 years until they kind of structure their advertising business. But at some point, you should be able to capitalize on what you have created to make money. It's good if you are able to identify your target audience. That can be quite hard to do early on, so it doesn't need to be an exact person with a name, but some expectation of what this end consumer is. The market size, again, demonstrate that this is sufficiently big for the investor to be interested. This is usually quite subjective from what we've seen. There are a lot of markets that don't have good data and they're not easy to quantify, but try to use as much statistical evidence as possible to build up on that. The team highlight your skills and experiences that make you appropriate to bring this thing to the market and be the right team to make this succeed. Your roadmap, what you want to do, you can't really do everything at once, and you, as I said before, you should strive to launch as soon as possible, and then develop develop through iterations and through feedback from the market. So you should have a roadmap and prioritize what you want to do first. Identify competition, either that being directly or indirect competition. Explain what you're going to do with the funds. A lot of the time, people just, I can ask for 300,000, but you need to tell us, or the investors, what you're going to do with it. Are you going to spend it all in marketing, 300,000 down the drain, or are you going to hire new people, buy new software that's going to boost your product, and so on and so on. And lastly, the financials, although they're not critical for early stage ideas, they're very useful to sense check what you are asking for, to sense check your budgeting, your unit economics, and that it all comes together. All right, that's all from us. Questions?
I don't know if you mentioned it, but how do you as a company make money?
Us as Crowdbase, we made a commission based on the successful funds we raised for a company. So if we raise for about 470,000, we take a portion of that money as our commission.
And if there's losses on the investment, that you have to give back to investors?
No, our role is essentially as the intermediary to find the money, and then the investors they have to manage. It's a bit more complicated, but they take the risk themselves and they manage their own investment.
Can anyone with an idea just come and get opinions from Crowdbase and get checked and analyzed from Crowdbase?
Yeah, we're happy to do that. To get on the platform, we just have usually we have one red line, which is to see at least an MVP. And that's for many reasons. But we are happy to, if you want to discuss and check some ideas with us, go back and forth, we're happy to do that at any time.
You have mentioned that mostly startups give away equity. Is it much more common to give out equity than debt?
Yes, for early stage startups, it's much more common because you don't have the money, the persistent money generation in order to pay back your debt. There's some other complex instruments you can use, like convertible loans, so a loan that transforms into equity in the future. But again, that's essentially just an easier way of getting equity at some point in the future.
Usually a startup is loss-making, especially in the first years. So given that it is loss-making, it will not be able to generate enough money to pay back the loan. So that's why you usually need a more mature company that has a financial history of generating cash flows and being profitable, so that you are reasonably assured that me as an investor lending money to this company, they will be able to pay me back. If I go to the bank and ask for a loan mortgage now, there are some requirements about my salary and my income that they take into account. If I don't have a salary, they're not going to give me a mortgage, for example. So this is the thinking behind it.
Yeah.
talk about structuring financial contribution in stages. Okay. So instead of you are talking about the example of food, you talk about giving initially 10%, then 5, then 10, then 10. Is it possible after you proved that you've accomplished some of your goals to get a debt investment later on instead of
Yes, that's quite common with some specific business model. It's called venture debt, essentially, which is high risk, high return debt for some funds that are willing to take that. It really depends on your business model. A lot of these like flex car, which you rent cars, or blue brown, where you rent apartments, because they have a lot of assets, they can borrow against those assets. So it really depends, but it's becoming more and more popular.
And also preferred shares are a common thing used. Preferred shares are a hybrid product which includes both characteristics of equity and debt. You can Google that and find more information about what the preferred shares are. Yeah.
Questions?
To expand on a previous question, how do you handle someone that comes with indeed some sort of idea which is for a niche market? Because it's difficult to get an estimate or evaluation of how many people will buy that. Or for example, we can say that we will have many customers, but if we have few of them for something which is expensive, we can also make our money. So
I mean, niche ideas, if you have a niche worldwide idea, is still a huge market. It can be bigger than the Cypriot economy sometimes. And one of my previous jobs, I was actually working with a lot of these companies that they were very hyper-focused on one little thing, but because if you scale that worldwide, you still have a big market. And yeah, you can have a few big clients, especially if you are business to business, or you're developing something very complex or very luxurious. But yeah, the market estimation is quite tricky. As I said before, try to use some reputable sources, and usually you can get a sense of what the market is out there. Plus, in combination with, you can see how much money has been already invested in a startup, plus the stage of growth that it's in already. You can use all these factors to figure out the valuation of the company.
So, as a startup, easy to. How as an investor, how do I approach them, or how do they enter your
Platform? So the startups can reach out to us. They can send us a pitch deck that we described before, and we begin the.
Not specifically for the previous example.
Again, the same way. We're happy, as I said before, if you just have an idea or you're going to bounce something with us, you can send us here, contact@Crowdbase.eu. We can start conversation and evaluating your idea. And we don't expect anybody to have all the material ready from the get-go, especially if it's an early stage startup. So we're happy to go back and forth and be like, okay, you need to think a bit more about your target audience or your market size. Let's work this together to figure out what the a realistic estimation is.
We assess each application holistically, so we pay attention to all the variables that have to do with this specific startup and this specific idea, because there's usually so many different things available, so you can't be have strict lines. So the only thing that we have the red line at is having an MVP, a minimum viable product, which is essentially a very basic version of your product or service with the basic features to showcase to the world that this thing just works, and then you can build after that.
Any other questions? All right, I think that's all. Just one last thing before I hand over to Konstantinos. We are actually starting to structure some internship programs at Crowdbase. So if you're interested and you want to do either from now until summer or during the summer full time, a month or two of an internship with us to see a bit if you're interested in the financial side or the tech side of things, or just in the entrepreneurial side of things, then feel free to send us an email at contact@crowdbase.eu with your with a CV and a short, I guess, cover letter of what you are looking to, what you would like to see or do with us, and we can explore if we can